Good afternoon. My name is Jennifer DeMott, and I'm the Executive Director of the Manufacturing Growth Alliance, also known as MGA. We're a membership-based organization that provides services to help manufacturers build smart and lead strong to establish a pathway for future growth. Our services drive solutions that make manufacturing in Michigan the most competitive and prosperous in the nation. Many times, manufacturers are unaware of tax credits to take advantage of, such as the Employee Retention Credit and the R&D tax credit. In addition, manufacturers often need support navigating tax and local, navigating state and local taxes. This webinar will provide you with insight about tax credits to benefit your business. You will also acquire insights into navigating state and local tax guidance. Today, we are going to hear from three professionals from Raymond who have expertise in a variety of topics related to tax credits and tax insight. Before I introduce our guests, I have a few housekeeping items to share. We encourage questions and comments, so please type the questions in the chat box at the bottom of your screen. We'll monitor the questions when they come in, and we'll make sure your questions are asked to our presenters. We are recording the conversation today to provide content to manufacturers after the webinar. So now let's introduce our guests. Mike Powell is the Director of Manufacturing Services at Raymond. He is focused on identifying opportunities to help clients reduce their tax burden. Chuck Wright is a Senior Manager at Raymond who specializes in tax and state and local taxes. He is a tax advisor to clients across all industries. Tony Lucavoli Jr. is a CPA and principal at Raymond. He supervises tax engagements for clients in a multitude of industries. Now let's welcome Mike, Chuck, and Tony. Thank you for being here.
Thanks, Jen. I'll kind of kick things off here. As you'd mentioned, we are going to speak about the employee retention credits, some state and local issues, and probably one of the most underutilized tax savings opportunities for manufacturers, the R&D tax credit. Just a little background on what Raymond is. We are a consulting and wealth advisory firm with 18 offices throughout Michigan, Ohio, and Florida. So we do your typical assurance work, tax work. We have HR solutions and Raymond Technology Services, which I mean, we have over 800 manufacturing clients, and so we have a wealth of great ideas to bring to those manufacturing clients. So I'll kind of kick it off here and speak about the R&D tax credit, in which just quick topics of discussion for this would be just an overview of what R&D is. We'll define what type of activities qualify for the credit and what type of expenses can be applied towards a credit. I will also discuss some taxpayer-friendly pronouncements that have come out over the past couple of years, in which we're seeing some clients in different industries really see high R&D tax credits. And so we'll kind of quickly define or just kind of go through the overview of the credit, in which the R&D tax credit came into play back in the 1980s, in which they were trying to keep intellectual properties here within the United States. And also at the time, it was more of a wage type of credit because we're keeping those employees involved with developing new products. It is a dollar for dollar tax credit. So it can offset your regular taxes and in certain cases, your alternative minimum taxes. So it's kind of like hitting a two-run home run in which you get the deductions for these expenses, but also you get to take a tax credit for these expenses as well. And we'll kind of explain to you what type of activities and expenses qualify for it. And kind of like the ERC that Tony's going to speak about, that's kind of a one-time hit. This is a yearly credit. And so all of our clients who take advantage of the R&D tax credit, it's each year that they get this tax credit to offset their taxable income. So quickly to define what the R&D tax credit is. And again, this is kind of like a nickel tour, just a general 40,000 foot overview. there has to be some type of technological uncertainty at the beginning of a product. Or the project, what is the appropriate design of a product? What is the appropriate materials we're going to use? What type of software algorithms are we going to write? So there has to be some type of technological uncertainty. The second part is we have to have a process experimentation. And this is really where a lot of manufacturers have a negative or wrong connotation of experimentation. You know, you walk through a manufacturing facility, they're doing trial and error all the time. So experimentation might sound like it's white lab coats and clean rooms, but it's typically what your manufacturers are doing day in and day out. They're trying to reduce scrap rates. They're trying to improve cycle time. So it's that trial and error to try to get to a certain part. The third part is it just has to be technological in nature. Your typical engineering, your typical software engineering, metallurgy. So it just has to be in the hard sciences. And for the fourth part is it just has to be for a new permitted purpose, in which that is defined as a new business component or a new manufacturing process. And I think on the next slide, we'll have some examples of those types of projects that qualify or things taking place. So we have new product development. You're coming out with a new product and you have to design that product. And also you probably have to design the manufacturing processes to make that product. You might have a product improvement. So you might have your clients coming to you or your customers saying, hey, could you do something X to your product? And we're improving upon those products or existing products. A new manufacturing process, and that could be either upstream or downstream. So you have a new product comes out, we have to develop new tooling, pick and place things upline, downline. So it is both developing that new manufacturing process or improvement to a manufacturing process. And I think, Jen, you and I had a conversation last week, I believe it was, in which one of the words of 2020 and 2021 was pivot, in which a lot of our manufacturing clients had to come up with new types of processes to keep their employees socially distanced or trying to automate that because of lack of employees. So it's a manufacturing process improvement. New tooling developments. So if we're developing new toolings, pick and place, end of the arm tooling, that type of activity qualifies for the credit as well. New formulas or techniques. And then in some cases, developing your software associated with your manufacturing process. So you have a CNC machine, you have to develop the new code for that to make your particular part, or you might be tool and die in which you're doing some sequencing. So if you're having engineers on staff or on site developing new software for your manufacturing processes, most likely those will qualify. And the three types of components or expenses, once you have a qualifying activity, there are three types of expenses we can apply towards the credit. First are wages. So the way that works is the crux of the credit is centered on experimentation. So who's ever doing the experimentation? We get to take a portion of his or her wages and apply that towards the credit. A second level is if whomever's supervising it. So you might have a senior person that's supervising a bunch of different types of qualifying activities, even though that individual is not getting their hands dirty per se, but they're supervising the qualifying activities. We get to take their wages and apply it towards a credit as well. Then we get to go a level below the experimentation. And the best example or analogy I can give here would be your quality assurance department. So you're developing a new product or you're improving upon a new product or manufacturing process, and you're making sure that the product that you're developing is meeting spec. So you take that to your quality assurance department. And your QC people aren't really experimenting, but they're supporting the experimentation of the project. The second part are supply costs. So what is this is defined, and I'll come after this slide, I will discuss where a lot of our clients are really seeing large R&D tax credits. So it's the supplies used or consumed in the process experimentation. So you're a plastics company, you're developing a new product and you're scrapping out your resin. That would be an R&D supply cost. And the third component would be contract expenses. So let's say you have to do some type of quality check and you don't have that technology in-house and you send it out to a third-party company, they're helping you develop that product. Also, if you're in the metallurgy area and you have to send out something for quenching or heat treatment, and you're trying to develop that new product, those types of third-party expenses can be applied towards the credit. Next slide. So when I was speaking earlier about some taxpayer-friendly pronouncements, there was a court case that came out a few years ago, and then some new regulations in which it says a first of its kind product or tooling can be applied towards the credit. A good example here is, let's say you're an injection molding company. So your customer comes to you and you need to develop this new product. They give you the specs for it. You go into mold flow analysis, or you have a third party do the mold flow analysis. You cut the tooling or send it out to a third party to cut the tooling. You bring that tool back in house, and it's pretty much guaranteed that that tool, that injection mold is not going to make that product to spec. You might have venting issues, gating issues. You might have short shots. So your team in-house is going to experiment with that tool. And more often than not in Michigan, once we get through PPAP, we sell that tool to our customer, but keep that tool in-house to produce the part. Well, there was a court case that said that cost of that tool is an R&D supply cost because you had to do experimentation on it. So give an example. So I work with a company in Ohio that's a direct supplier to an automotive company. And they were looking at the R&D like it used to be before these taxpayer-friendly pronouncements. And their credit, it's a pretty good sized company, was around $125,000 to $160,000 a year. Once we started bringing the tooling into the equation, we were looking at a credit of $1 million. So it used to be about 75 to 80% of the R&D credit was wage-based, but in some industries like plastics, tool and die, and companies that make automated systems for their customers. So a customer will come to that automated company and say, hey, we want to automate this, and they do some type of assembly and conveyor system. Because it's a first of its kind product, all the supply cost or cost of goods sold associated with that product, even though we sell it, is an R&D supply cost. So that's probably the big takeaway here is what type of activities qualify, what expenses can be applied. And then in some industries, even if you're selling that product and you had to do it, R&D on it, it's a first of its kind product, that is an R&D supply cost. So is there any questions, Jen?
Yeah, just a couple questions right now. Is there a min or max to the tax credit?
No, there is not. The ballpark is, if you want to do the back of a bar napkin, it's usually around 6.5 to 7.5 cents on the qualifying expenses. So there's no min or max on that.
Okay. And how long has the R&D credit been available? And our manufacturers who are listening, are they able to go back if they're saying, wow, I didn't know this was available? Could you help them understand what could be some of their next steps to even go back?
Yeah, so the statute of limitations from a tax standpoint is 3 years. 3 years from when you last filed that tax return. So there are availabilities to go back and amend the previous 3 tax years, depending on when they filed the earliest of that 3rd year tax return.
And I have a question. Of the 800-ish manufacturers that Raymond works with, just to think of a scope of who's accessing this tax credit, about what percent of the 800 have a qualifying event for this tax credit?
That's a good question. We provide R&D analysis, and some people use a third party, unfortunately, to do that. But we do somewhere around 250 R&D tax credit studies a year.
Okay. All right. And then I don't see any other questions right now. There may be some that will surface that we can circle back to you on Mike.
All right, so we're going to start off with on the employee retention credit with a little background on the credit. I think that will help explain, why all of a sudden everyone is talking about the employee retention credit, because it is a very popular topic, not just with manufacturers, but across all different business lines. So The credit itself has been around for over a year now. So it was passed back in March of 2020 as part of the CARES Act. But probably up until December, most businesses and most manufacturers probably haven't heard much about the employee retention credit. And the reason being is that if you had taken out a PPP loan, and this is talking about PPP-1, you were not allowed to claim the retention credit. And then in December, Congress ended up changing this. Not only did they expand the retention credit into 2021, the more important thing is they removed that PPP loan restriction. And they didn't just remove it for 2021. You can also go back into 2020 and claim that credit on wages you've already paid, even if you've taken out a PPP loan. So that really created just a lot of opportunities to, for businesses, for manufacturers to go back and amend their 2020 payroll tax reform, tax returns, and those are done on a 941X because, this credit is a payroll tax credit, and then claim that credit in 2020 for wages they've already actually paid to their employees. And those opportunities for 2020 still exist. Even 5 months into 2021, you do have 3 years to go back and amend a 941 return and claim this credit. The only issue is that it is also taxable in the year that the wages were paid. So you have to keep that in mind as well. And the 2020 credit, that credit alone is up to $5,000 per employee. So, if you look at even a smaller manufacturer, let's say you have between 20 to 25 full-time employees, you could still be looking at a six-figure credit, assuming that you qualify. And in 2021, you can even be looking at a much higher credit, as we'll see in an example below. So now looking at this slide here, we're going to spend, if we can go back actually one slide, we're going to spend a minute or two on some of the basics on how the credit actually works. So, as I said, that credit, it's a payroll tax credit. It is refundable, meaning that, any excess does come back to the company in the form of a check if it's refunded through a amended 941X. If it's on an original 941, that credit amount can be carried forward, or you have the option to refund as well. And there are very different rules for 2020 and 2021. So again, for 2020, that max credit is up to $5,000 per employee for the entire year. You can't go any higher than that. For 2021, that max credit goes all the way up to $7,000 per employee per quarter. So you're potentially looking at $28,000 a year per employee if you ended up qualifying for all 4 quarters in 2021. We'll talk about what you need to qualify and what it takes. So, and again, if you look back at our smaller manufacturer with 20 to 25 employees, under the 2020 rules, the credits, could be up to, 100 grand. It's 6 figures, certainly not a small amount. But if you were to recalculate that same company, the credit amount under 2021 rules could be in excess of $500,000. So, obviously a much larger number under the same scenario under 2021 rules. Now, like I said, you have to determine if you qualify first, before actually claiming the credit, meaning are you, if you're looking on the right-hand side of that slide, are you an eligible employer? And to do so, you have to meet one of 2 tests, only one of the 2. And again, we have different rules for 2020 and 2021. So for 2020, you have to have had either a greater than 50% revenue decline in any quarter in 2020 compared to that same quarter in 2019. Or you have to have had a full or partial suspension of operations due to a COVID-19 state or a COVID-19 government order. And we'll discuss a bit more about what a partial suspension means on a couple slides from now. So again, looking at the right-hand side of that slide, for 2021, that threshold drops from a greater than 50% decline in revenue to a greater than 20% decline in revenue in any quarter compared to 2019. So you're always comparing back to 2019 as your base normal year whenever you're doing any of these tests. And then you also have the option in 2021 to look at the prior quarter to see if you meet that 20% decline. Now, the full or partial suspension of operations test is also available in 2021. You know, that test is going to be much harder to reach, especially, you know, in 2021, especially if you are a manufacturer, because, you know, obviously restrictions in Michigan have lessened significantly over the past year. So it's going to be a much harder test to meet. So really, you know, a good portion of our manufacturers are going to be looking at that 20% revenue decline test to determine their eligibility. And again, you look at it to determine eligibility in each quarter. So moving on to the next slide, qualified wages. So, you know, qualified wages are limited to $10,000 per employee. And you get to include both wages as well as the healthcare expenses that you incur. And again, remember, so the credit is up to 50% or up to 70% of those qualified wage amounts, depending on what year we're talking about. So that's when I was talking about a $5,000 or $7,000 per employee cap. It's based off of 50% of that $10,000 or 70% of those $10,000. And for 2021, this credit, it's much more beneficial if your employee count is under 100, or 100 or less employees, I should say. And then that goes up to 500 or less employees in 2021. So you can still claim the retention credit if you're over this employee count, but only on wages that you paid to employees who are not providing services. So you can think of it as wages paid to furloughed employees or employees who are working in some type of reduced capacity but are still receiving their normal wage. But that rule only applies if you're over those employee count thresholds. If you're under 100 or 500 employees, again, depending on what year we're talking about, all wages that you pay to your employees and all healthcare expenses that you incur are qualified regardless of if they're working or if they're not working. So it's a big distinction there between those two employee count thresholds and those rules there. A couple of items I just want to point out. All these tests, like the gross receipts decline, like the employee count, you have to do this on an aggregated group basis. So you may have to gather data across multiple related entities. And these rules, to determine whether or not you have really a single employer, these rules are not the same as the PPP affiliated group rules. So you cannot rely on any analysis you did for PPP purposes for the retention credit purposes. One uses SBA guidelines, and one, the retention credit, uses the Internal Revenue Code. So a completely different set of rules. And we can move on to the next slide, but I just want to mention, as I brought up PPP, you cannot use the same wages for both programs. But, you know, with that being said, there are ways to maximize the retention credit while still receiving full forgiveness on that PPP loan. And I think that's why, you know, discussion with, you know, whoever your advisors are, you know, is very important, because you want to make sure that you're being able to utilize the full benefit for both of these programs here. So, you know, looking at this slide here, I really want to focus on that step one, and that's determining eligibility. So, you know, for 2020, again, you want to test your gross receipts. You want to look and see, do I have a 50% or greater than 50% decline in any quarter compared to 2019? And, you know, again, if you've taken out a second round of PPP, you would have already pulled all these numbers together anyways to see if you met that gross receipts decline that's required for PPP2. It's a different threshold. PPP2 was 25%. This is a greater than 50% decline, but you may have already all that information already handy. And then again, we're talking about 2020 still, but if you don't meet that 50% decline threshold, the next step is to determine if you had some type of partial suspension of operations in 2020. And the key word there is a partial suspension, not a full suspension. A full suspension will obviously that will qualify you, but you do not need that. And that's kind of one of the biggest misconceptions behind this credit, is that you have to have been fully shut down at some point. And that's just not the case. That's not how the rules of the credit work. So, a partial suspension can mean a lot of different things. And it's really fact and circumstance based, but it can be something like a capacity limitation. A partial suspension can mean operations and limitations placed on those, like, for instance, essential work restrictions. We have worked with a lot of manufacturers that could only work on projects that were deemed essential, meaning that they actually received letters from their customers saying they were, this customer was essential and that you can work on our project. And many manufacturers took the position that, okay, we will work on these, but we will not work on any non-essential clients or customers, because, it's very rare that we've seen one manufacturer having strictly essential work customers. We've also seen a lot with being unable to visit customer sites to either provide some type of installation or some type of service. That could obviously qualify you as well. And then there's the simple and easier scenarios to analyze. If you had a manufacturer that took the position, at least in the state of Michigan, that they were not essential when some of those government orders came out in March, and they fully shut down. So obviously those businesses would qualify, at least for that period that they remain shut down. And, Michigan, talking about those government orders, Michigan had very strict COVID restrictions placed on businesses early on. And for non-essential manufacturing, I believe starting March 24th and going sometime through the first or second week of May, manufacturing had a restrictive order from the state of Michigan placed on it. So again, that can help a lot with demonstrating that you are eligible for this retention credit. So if we can move on to the next slide, I do want to end with a couple action items, one for 2020 and one for 2021. And I'm going to reiterate what I just said, but again, discuss 2020 eligibility with your team, with your advisor, to determine if you meet one of those tests. Again, really, obviously the gross receipts test, pull those numbers, but again, think about if because a lot of our manufacturers did not have a greater than 50% decline in their gross receipts. So think about if you had a partial suspension of operations at some point. And then for 2021, and this applies to all the quarters, but specifically for quarter one, compare your gross receipts Q1 2021 to Q1 2019, and compare your Q4 2020 gross receipts to Q4 2019, and see if either of those gets to a greater than 20% reduction in your sales or your gross receipts number. So now I'll end with that. Really, make sure if you do these two items, you should be covering most of the retention credit in terms of thinking about whether or not you're eligible. And these credits, as we talked about in a couple of basic examples, these credits can be very significant. And every manufacturer that qualifies should be taking advantage of them in one way or the other. So, I'll turn it over to Chuck unless you have any questions that have come in, Jennifer.
Yeah, there are a few questions. This first question is a little detailed, and it's in a couple different parts. So I'll read the full question and then just circle back if you want me to reread something. Question is the gross receipts test done on a cash or accrual basis? Can you please explain the aggregation test for gross receipts and employer designation, small, large? And then there's an i.e. We have 2 local plants, but are part of a much larger holding company with other facilities. Are the tests done at the holding company or the individual plant level? Thank you.
Yep. So for the first one on the gross receipts, that is done on whatever your tax return is being filed on. So it could be accrual and it could be cash. It just really depends on how that tax return is being filed. And it sounds like we'd be looking at the holding company because I'm assuming they're the ones filing that tax return. The second question about aggregation. So the rules for aggregation are one of the most complicated sections of the tax code, I think. They're borrowed from the retirement plan and the healthcare plan aggregation rules. There are too many nuances to list out, but one easy step, the first step would be to look at, did I have to aggregate my retirement plans across the entire holding company, or did I have to aggregate my healthcare plans across the entire holding company? That's step number one. If the answer is yes, we had to, chances are you have a aggregated group there for ERC purposes. Because again, in the tax code, they like to borrow from stuff instead of rewriting stuff. So the ERC rules pulled directly from the single employer rules for healthcare and retirement plans. And in terms of, is the test done at the holding company? I'd say there's a 99% chance it would be, assuming that it holds all 100% interest in whatever these subsidiaries are.
Okay, great. Hopefully that answers.
I think I answered everyone on there.
I think so. So the next question focuses in on the 2021 20% reduction in gross receipts. On one of your first slides, it indicated COVID related as a direct result of COVID. Is it assumed that any reduction, if it's 20% or greater, is there an assumption there, or does a manufacturer need to attribute that reduction specifically to a COVID related cause?
Yeah, good question. No, there is no requirement that it be caused by COVID, that you demonstrate it was caused by COVID. The only COVID-related test was the partial suspension or full suspension, and that you have to demonstrate was caused by a COVID-related government or state order that affected you.
Okay. And I know it's been a few weeks ago, I recommended a manufacturer to talk with Raymond because their current CPA firm didn't have the breadth and depth knowledge related to this topic. Is that an option for the manufacturers that are on the call to reach out to Raymond for an initial, just a brief conversation about what steps they can take? Because it's complicated.
Yep, absolutely. Yep, absolutely. We're glad, we work with plenty of clients that are not Raymond clients up until the retention credit or PPP time. So we're happy to get on a call and discuss the retention credit with anyone.
Okay. And Tony, I think that's all the questions. So thank you so much.
Okay. All right, I'll turn it over to Chuck.
You're up, Chuck.
All right, thank you. Thank you to my co-presenters, and thank you, Jen, for inviting us. For my topic on state and local tax today, I thought of my audience as manufacturing, and Michigan use tax audits are one area that virtually every one of my manufacturing clients has had to deal with. And I've been doing this for 30 years or so. This is a very common audit, and it's done because Michigan Treasury gets most of their revenue through sales and use tax. The corporate income tax, even the individual income tax is a small fraction of the budget, but these taxes are 6% on the gross transaction. So the money is definitely on this side of the table. So let's talk just briefly before we get into the audit cycle. Sales taxes versus use taxes, and we sometimes use those terms interchangeably, but it's really important to understand the distinction. Sales tax is imposed on the vendor, the seller, and it's on the privilege of selling tangible personal property at retail. manufacturers are not getting as much audit activity on this side because Michigan has such a broad industrial processing exemption, which I'm sure all of you have heard and are taking advantage of. Anything in industrial processing that is used in the process or as an ingredient to your product is not subject to sales or use tax when you buy or sell it. So the main thing on sales tax audits is to maintain, when you sell your product, is to maintain exemption certificates. When your customer buys from you and says, don't charge me tax, you want to get a certificate, and that proves it's not a retail sale, and you're off the hook once you have that certificate. Use tax is different. Use tax is on the privilege of using, storing, or consuming tangible property. It's what you buy versus what you sell. This is where Treasury is focused, on the Michigan manufacturing population. Next slide. They are really going to focus on 4 areas. And this is from a lot of experience and talking to the auditors about what their audit program is. This is where you need to focus your documentation going forward, and where you need to think about if you're under audit right now. Capital purchases of office equipment and furniture. Again, this is things that you have purchased that you may not have paid sales tax on in Michigan, or use tax if you bought it from outside of the state. This is on the use of this equipment, and it's not exempt for industrial processing in your process. Now you're the buyer. Office equipment and furniture is an example. It's not part of that manufacturing process. Capital purchases of equipment now that are used before or after the process. So that in Michigan, we have a lot of court decisions that define where the process begins and ends. And things that are before and after that process don't count. They're not exempt. Consumable supplies. If you think about things that you buy in office supplies, fluids, things like that may not be part of the industrial process. And finally, utilities. Next slide. We'll go into each one of these in some detail. Capital purchases really for the office. The first thing Treasury is going to do in an audit and in requesting documentation from you will be a list of your purchases during the 4-year audit period. They will go down and flag, they'll try to do a sort in Excel if they can get it, all the computer and peripheral equipment. The assumption will be that that is not for the industrial process. Office furniture, desks, cubicles, things like that will also be flagged. It's up to you then to show whether any of that is exempt. And note that computers very often are used in the industrial process. They are used for design, manufacturing, production equipment, design, engineering. In that case, they're exempt. They're part of industrial processing. It's up to you to show and identify which of those computers are exempt. If you could have done that in advance of the audit, you're way ahead of the game. And that's probably the one thing I would tell you to remember from today, is to be ahead of this. You don't want to be playing catch up. Next slide, please. Excuse me. Capital purchases before and after the process. The courts have defined the industrial process as when you take raw materials from raw materials inventory into the production process, and then throughout the process all the way to finished goods inventory. So they're looking at items that are used or equipment that is purchased and used before we get to raw materials inventory, and after, so basically shipping and receiving, taking it off the truck, taking it into inventory, finished goods coming out of inventory and onto the delivery trucks. The main one they focus on is forklifts. So you may have 10 forklifts 5 of them may be completely used within the manufacturing process to move things from one area to the next. Several might be used to unload raw materials or component parts, and some are used to load the trucks on the way out for delivery. Anything that is exclusively used before and after the process will not be exempt, and the fuel that goes into it. If they are mixed use, we want to get ahead of it, document the percentage of exempt use, and Treasury will allow that. That's very, very common. But the more thought you can put into that in advance and document why you came up with 70% exempt, who you talked to, things like that, you're way ahead of the game. Treasury does not want to recreate the wheel. If you've got this covered and you can bring them in to the audit process and show them that you're taking it seriously, you've got a plan, here's your documentation, I've done all the work for you, they can check the box and be done. Next slide, please. Consumable supplies. This is not a huge one, but it is one of the 4 areas that they will look at. We're thinking about, again, items that are not part of servicing the production equipment. So fluids and things like that, lubricants that serve the machines that are making the equipment or that are making your product are exempt. We're looking for janitorial things, mops, paper towels. And what I should have put on here, another big one is office supplies. If you can identify that in advance, do the work for them. This is often an area that my clients will have purchased everything, excuse me, exempt. And they'll throw a bone to Treasury. Oh, you got me, I owe you $42. Here you go. Pens and paper for the printer. It's often a good one to give them something to take away from that's not really meaningful, but it's often missed. Next slide, please. Utilities. This is a big one. It's one that we don't often think about, but this is one of the main areas that Treasury will focus on. One of the things they will ask for on an audit in the initial document request is a footprint of the facility. And they will want to look at square footage. They will want you to identify where the office is. And that area will not be considered exempt. They will look at the area, again, we said prior to production and after production. And they'll try to do a square footage analysis and say of all the utilities, the gas, electric, and water that you purchased during the year, you said it was all exempt. Well, these areas, this is 30% of your facility or 10% based on square footage. That is taxable. So my clients typically are either purchasing everything exempt or they're giving the utility companies a percentage of exemption. And in a lot of cases, I found more often than not, when a percentage is given to consumers or DTE, most of my clients are being conservative. And we find on analysis that they're overpaying. What can happen is we do this on a square footage basis, and the shop floor, the manufacturing facility has 30-foot ceilings. So it really should be on a cubic foot area. The ceilings in the office are much smaller. It's not comparable apples to oranges to do everything on square feet. The taxable area can be much smaller than you think. But again, this is a great way to get ahead of it. Do your analysis, show them exactly that you've thought about this, you've put some science behind it. That's all they want to hear. You're in and out, and it's a much, much better experience for you financially and time-wise to do this work in advance. Next, contact information. I'm at the top there. My boss, Lisa Pohl, is just below me, and Renee Storms is the other senior manager. We would all be glad to help you out with this if you have any questions.
Yeah, thanks, Chuck. What's the biggest mistake manufacturers make when preparing for an audit?
The biggest one is not preparing. I think the more you put into it, and if you take them seriously, that's all they want to hear. The worst thing you can do is ignore them. They're not going to go away. They're just going to get mad. If you don't give them what they want, they will use the best information they have, and it's not going to go your way. They're gonna guess big. If you do the work for them and you show them that you respect their time, you're going to come out way ahead.
And so you mentioned a lot of information tracking. Are there templates out there that you would recommend that manufacturers might not have to start from scratch?
No, I think you want to look at the four areas that I talked about and really focus on capturing that data. It's typically in SAP will allow you to do an Excel download and sort that for them and say, okay, I know you're going to be interested in computers, so I've sorted this for you. This is what we have. These 17 computers are used in production. The rest of them are in accounting and finance. I'm going to owe you on that. Here's the amount I've computed. I owe you. I mean, the more you can do, that shows them that you understand the issue and that you're on top of it. I've had some of these information meetings last an afternoon, and we had the audit wrapped up in a week. It's otherwise, if you ignore them, they won't go away. It can go years. Sometimes they will ask for a document and your system doesn't really call it that. It calls it something else. Don't ignore them and say, we don't have that. Just ask them what they're looking for and say, I can give you this instead. It's going to get you the same place.
All right. There are no further questions, Chuck.
Okay.
So I'll open it up to Mike or Tony. Chuck, anything else that you'd like to share prior to us closing out today?
No, it's been a pleasure talking to you, and I would be glad to talk to anybody that's got a question on any state and local issue. Call us and we'll talk about it.
And thank you to MGA for giving us the privilege to speak today. We really appreciate it. And our goal here is to help manufacturers the best that we can. So as that last slide indicated, we have a very integrated approach. We have what is called One Raymond. So you typically will have a business advisor, but also we have the bench strength of specialists throughout this firm that can help any manufacturer. And typically when we meet with a new client or a new manufacturer, we ask, what keeps you up at night? And so whatever is keeping them up at night, we probably have the specialist within Raymond to help that individual out.
All right. Well, thank you again very much for your participation, Mike, Chuck, Tony, and for those that have joined today. We did record the conversation, so MGA will send a link of the recording out to those registered, and for the few others that have already requested the recording. So thank you again, and enjoy the rest of your afternoon.
Thanks, Jen. Thanks again.
Me too.
Thank you, Jen.